The losses to the Fed are going to be grotesque, and they're not going to stop. I have suggested to them privately that they should CMO all their mortgage debt and sell it, but they don't want to do that because it would be politically very ugly. So that's my expectation. The driver will be Treasury. Now, if you saw a big uptick in unemployment, sure. Would they drop interest rates? But the kind of action I'm worried about is what they do with their balance sheet. It's not the target for Fed funds. It's how much paper are they buying.
I'm its founder and its host, Gary Bohm. Today, we have a fantastic discussion lined up. We're fortunate to have with us Chris Whalen. Chris is an investment banker and a writer who lives in New York. He's a chairman of Whalen Global Advisors, and he focuses on the banking, mortgage finance, and fintech sectors. Chris, thanks so much for joining us today.
Hey, my pleasure, Gary.
All right, let's begin with a look back on 2024 from an economic and market perspective. What surprised and shocked you? What fell right in line with expectations? And what are you expecting moving into 2025?
Well, I think the big surprise to me and to most analysts was how much momentum the U.S. economy was still carrying out of COVID, particularly just liquidity, the amount of money that the federal government spent, and just the huge amounts of liquidity that just stayed in the system. You can see this with the Fed slowly reducing what they call reverse repurchase agreements, which are essentially the Fed issuing their own T-bills. And they had to do this because they put too much cash in. So in order to rebalance the system and keep it from running off the rails, they literally had to soak up all this liquidity and create new securities just for money market funds, the GSEs, Fannie Mae and Freddie Mac, foreign banks. This is all illegal, by the way. The Fed is not supposed to be taking deposits from foreign banks. But there you are. So, I think what surprised everybody is that we didn't have a recession. Remember, everybody was ready for a recession in the summer. Didn't happen. And in September was a boom. You had some of the most issuance of securities, particularly debt. That carried into the fourth quarter. So I expect the numbers for the banks to show pretty robust capital markets activities. But overall, I think the big surprise was things did not slow down when everyone thought they would, and credit did not run off the rails. That's largely, thanks to the Fed. The Fed, when you dump enough money in the street, you make the cost of credit disappear. And that's what they've done, especially in housing. So, I think that's the real surprise. It was an upside surprise.
With the reverse repo draining down as much as it has and getting closer to zero, with the almost $10 trillion of maturing debt that's coming due, with the $2 to $3 trillion in fresh new deficit spending that they're going to be doing this year, are you expecting liquidity to change?
Well, it is changing. That's the thing. The Fed uses a model built many, many years ago by an old friend of mine who used to work at the Fed that was really made for short-term estimates of liquidity. They use it for long-term estimations. And the problem is that when you aggregate things like liquidity, it's very hard to measure it in particular. That is to say, do certain parts of the market, like small broker-dealers, have access to liquidity? So we're feeling around in a dark room looking for the floor, but we're not sure where the floor is. And that's the real dilemma with the Fed. They're trying to normalize right now. They want to get their balance sheet back to the way it's supposed to be, which is all treasuries. They want to stop reverse repurchase agreements because that's extraordinary. And then they would like to, see the Treasury start to do short, medium, and long-term issuance. During the Biden administration, it was all T-bills. So that's kind of where they are right now. They're trying their hardest, and I think in good faith, to get this right, but it's really hard to get it right.
Do you find it interesting that Stanley Druckenmiller is shorting the long end of the market while one of his colleagues is moving into the area where he's going to be issuing those very pieces of paper?
Well, there are still some old bears out there like me who think that they can play the long end for that trade. I'm not sure, though. I really look at the global scene, and there's such demand for risk-free collateral that I'm not sure that the bond market's really going to show a bear tendency the way people think. There's an awful lot of money that's been lost betting against this market. And again, inflation makes the market go up. I'm reissuing my first book, Inflated, next May. And that's the story. I had to look at the last 15 years and say, what changed? What changed is that we still can't seem to engineer deflation in this economy. That's really the bottom line.
So, Chris, the dollar index is super strong today. It's crossed over, I think, 109. If you had to make the case for it, why must the dollar weaken, and why will it weaken? And is that what you expect to happen in 2025?
No, everyone keeps calling for the role of the dollar to reduce and for, other currencies to step forward. That's not what's happening. The euro and even the Chinese yuan have been losing ground. The yen is kind of stable. And what you're seeing is that many countries are diversifying their reserve holdings into the currencies of their neighbors and their trading partners, because that makes sense. I think it's kind of like entropy. We're seeing the end of a long period of stability after the war, after the Cold War. Obviously, the dollar is the franchise, right? Because we won. But how do you change that? How do you start to get the short-term dollar to go down? Because by rights, if you look at our fiscal situation, if you look at our demand for capital, the dollar ought to be going down, but it's not.
It's an interesting dichotomy going on. So
I think you have to think out of the box on this, especially if you're a trader and you're taking positions here. Ask yourself why it is so strong. And I think in part because people are running away from different parts of the world that they don't like right now, even China.
Well, that makes sense. So with Fed Chair Powell stating that there won't be significant rate cuts this year and the yield curve uninverting along with BTFP going away, banks were hammered at the end of the year, as most of them have billions worth of unrealized losses in bonds. Do we have a potential banking crisis brewing here?
Only if anybody notices. You see, if the 10-year, it closed the year at about 4.6. So the mark to market on the bank securities portfolio is worse than it's been in 2 years. The loan book has slowly repriced. They still own a lot of old loans with low coupons, but the average coupon today in the industry is, mid to high fives. So that's okay. But the problem is, you look at a Bank of America, they've got $500 billion worth of mortgage-backed securities with an average yield below 3. Where are threes trading today? About 81. So, it's very easy to mark this stuff to market because we know what they own. Most big banks today, remember, Gary, are half mutual fund. They're only half lent out. The other half of the bank is basically securities. So if you don't pay attention and watch duration, watch what's going on with the Fed, and really watch, don't listen to what they say, right? Watch what they're doing. You get into the trouble that, Bank of America, PNC, Truist, they're all underperforming. Schwab, the reason Schwab is being punished right now is because they're not minding their business when it comes to running Treasury. And you know what? I don't want to see them stellar. They don't have to be American Express, which is unbelievable, by the way. They've got a yield on their book of 5%. Just be near the peer group. That's all I'm asking, right? Mediocrity.
Not too much. Not too much bad.
Well, no, but these are huge institutions. So when you get this stuff wrong, like Silicon Valley Bank did, it has big implications.
Very big. Yeah. So, Chris, there's been no downward movement in mortgages, auto loans, credit card rates after 100 basis points of Fed cuts. In fact, it's gone the opposite way.
It went 100 the other way.
It's gone the opposite way. Why is this the case? And do you expect the strength in loan costs to remain in 2025?
Yeah, I do. What happened in the short run is that spreads widened. When we, in September, when everybody was basically, thinking 3 rate cuts this year, right? We were writing 5.5s in the residential mortgage market. Yeah. Today we're writing 7s. We could be writing 7.5 shortly if you look at the forward market. And again, it's because the difference between the 10-year and some of the other benchmarks has widened out. You don't have the Fed buying securities. And all my friends in media who cover this market, right, they keep writing these long, heartfelt pieces about how the banks are going to come back and buy more mortgage backs. So I keep looking at them and I say, no, They're going to keep their exposure pretty tightly controlled. They'll buy whole loans before they buy securities for portfolio. But I think by and large, the banks want to own big fat mortgages, $1 million, $2 million, $3 million condo loans that have 25 bips of servicing on them, right? Instead of that $300,000 loan to some family somewhere with 25 bips of servicing, right? That's why Jamie Dimon doesn't buy government loans. He only buys big conventional loans and jumbos, and he loves it.
I think I saw a stat today, mortgage demand down something like 24% or something, either last month or last quarter, something to that effect. I mean, are you expecting that to remain as long as mortgage rates remain elevated and housing is, I guess, deemed unaffordable, more unaffordable than it has in a very long time? Are you expecting mortgage demand to remain very, very weak?
I am, because what's happened in the market is, first and foremost, refinancings have pretty much disappeared. They're less than 10% of volumes today. They were more than half of volumes in 2020-21 when the Fed had rates at zero. Now, that wasn't normal. So we would like something in the middle without a lot of volatility, right? You have to get rates down into the fives in order to really start to pull more homeowners into the market, just in terms of voluntary sales and also refinancings. So you won't see volumes come back until then. Now, you'll still write mortgages. We'll still do $1 trillion worth of mortgages this year because people die, people have to move, they get jobs, whatever it is. The average life cycle for a family in high cost markets like California or the Northeast is 4 years. Yeah. So either they're going to try and move up or they're going to move out. And that will keep some flow in terms of purchase mortgages, but those are very expensive loans. Purchase mortgage costs $12,000 today on average to originate. So, the industry is still losing money. They make money keeping the servicing piece of the loan, but the actual loan itself, when they sell your mortgage into the secondary market, they break even.
Yeah. So mortgage delinquency trends, they seem to be a bit concerning. Are you seeing any dangerous cracks or fissures forming in the housing market?
Yeah, big headline we didn't talk about earlier was obviously credit card and auto defaults have started to rise. They're at about 2010 levels. Is that the end of the world? No, but it's certainly higher than we've seen in recent years. Is it going to break out? That's the big question for next year. If we see credit card default rates go up, then the next question is homes and mortgages, which, the bottom quartile is under a lot of pressure, but the rest of the stack, no.
So I saw a stat somewhere that said starting in December, the reporting agencies are going to start reporting on the student loan non-payments, the delinquent payments for student loans. How much of an impact is that going to have on mortgage delinquency? Are you expecting that to push them higher?
Well, look, the cash that students have saved because of various moratoria is very significant. You saw this during COVID. When people didn't pay their mortgages, they accumulated cash.
It was something like $383 a person or per month.
So that's pretty much gone. And when you start loading up more payment obligations on people, whatever it is, then yes, you're going to see delinquency go up. I think delinquency today, if you look at the FHA numbers, is probably understated by about 3%.
That's
interesting. So if you think delinquency on average for FHA is about 11.5 today, it should be more like 14 or 15, which is a serious problem. Yeah. Now, here's another interesting wrinkle. The FHA is changing the rules that they used during COVID, allowing lenders to basically do what we call a partial claim to keep people out of delinquency. So we didn't report them, and we would get a small claim from the FHA to make us whole, kind of the way Fannie and Freddie make lenders whole in the conventional market. They didn't have this before with the FHA. Once they stopped that in 2025, the delinquency rate on government issuance is going to go up a lot. And I don't think people are ready.
And all of this is with unemployment at near historic lows.
Yes, well, people are fully employed. I think people in this economy are working their asses off to survive. I see it all around me with vendors and other people I talk to. We're also seeing a lot of involuntary sales in mortgages. People who've been delinquent have had modifications and kind of tried to catch up but couldn't. Eventually, they sell the house.
Yeah.
And that's, again, because of financial stress, inflation, whatever you want to blame it on. Those people are being forced to sell the house because they can't stay in it. They can't afford it.
Yeah. Well, the variable costs on the backside of the loan, like insurance, property, there's no cap to that. And so where people bought post pandemic based on their debt to income, that's changed completely as this non-capped, non-variable expenses or variable expenses that have no cap. They just continue to explode.
That's correct. And think of it another way, Gary. Banks and the non-bank financial companies have seen their escrows grow enormously. So not only do you see bigger escrow deposits held by banks, but the non-banks also see much bigger flows because taxes and insurance are going up. Okay?
Yeah,
they sit on that insurance money for a year before they disperse it.
So, here we are fully employed, 4% or 4.1%, unemployment. If we have a recession and a typical unemployment event, I think the average unemployment spike is like 3.6, 3.7. With these numbers already where they are, they're not, very low. They're actually pushing on the high end of the spectrum. If we end up having that kind of event, that could be a very serious issue.
I think it already is. If you look at the amount of redundancies and just layoffs coming from the corporate sector, there's a big churn out there. I also think a lot of people are looking for different opportunities. They don't like where they are, and they're going elsewhere, changing industries, etc. So there is a huge amount of churn. You see this in the mortgage sector, by the way, with the servicing operations. Those are big labor-intensive businesses where you need managers who know what they're doing. And unfortunately, as soon as you train them up and they start to become really effective, somebody grabs them. It's extremely competitive.
So, Chris, let's turn to the stock market for a second. As stocks hit all-time highs, corporate insiders and executives, they seem to be cashing out of their stocks at record levels. In fact, there are now 6 times more inside sellers than buyers. Why are insiders cashing out of the strongest market in history? What's happening here?
I think just a magnitude change that many of them have seen since they, for example, got option awards or what have you, is pretty compelling. And the group you're talking about are in the age where they need to be putting money away for retirement. So if you've seen your stock move a couple of 100%, which is entirely possible in some of these sectors, it's very tempting. And indeed, I think appropriate for them to take the money off the table. Now, you as an investor, should you be jumping in? Well, yes and no. I mean, the yes is the inflation factor from the Fed. No is that we're probably going to see a correction at some point. The performance last year for my banks, for example, was extraordinary. 45% on average for the group we watch for our bank index. That's pretty amazing for a bank. They usually don't run that fast.
Are you expecting a turn down in the markets in 25?
Yes, I do think people are going to take money off the table. They're already doing it. The peak in large cap banks was kind of third week in November, and they've been trending down since then. You'll see other sectors, I think, take profits. The real question is, can we get the new issue market back? Can we actually get some IPOs that are of the quality that people care? We haven't seen that in the last couple of years.
Yeah. Well, that'll be interesting. All right. So, Chris, the global economy is getting the biggest coordinated easing. I believe there was 66 rate cuts and counting in the last 3 to 4 months since the 2008 GFC, at a time when macro conditions look nothing like the GFC. Why is this happening? Are they trying to prevent something dire from happening, or is something else going on?
Well, the dire thing that's happening is just debt levels for the G20 nations are quite high. I think we could all anticipate some sort of restructuring. I noticed that Argentina is doing quite well. They're renegotiating a new loan with the IMF. But the Milei, the new president, has really done an amazing job getting. But there are many other countries out there that are just wallowing in debt. Look at Great Britain. Look at Germany. COVID and then the crazy reaction after COVID with EVs and all sorts of mandates have hobbled the European economy. The Ukraine war has certainly not been helpful. So there's a lot of headwinds out there in the major industrial countries. The U.S. is the remarkable thing because largely thanks to the Fed, we've continued to grow very strongly. even though by rights, if you get the textbook out, we should be, having a recession, but we're not.
No. So, okay.
We have record issuance this year in debt and equity. I mean, mostly secondaries for the equity market, but that's extraordinary. It tells you how much cash is out there looking for a home.
Yeah. At some point, that'll get sopped up, right?
Well, that's the idea. We've created this interesting machine in the United States. We recycle foreign deficits. We do all sorts of things because we grow. And the other factor, of course, Gary, is that we're one of the few places in the world that people trust.
Yes.
The Russians and the Chinese could back their currency with gold tomorrow, but are you going to give them your money to watch? No.
It's a good point. All right. So, Chris, according to Standard & Poor's, more than $2 trillion of commercial real estate mortgages will mature over the next 2 years. Mm-hmm. The average interest rate on the maturing loans, which were underwritten in 2021, it's only about 4.3%. The loans really need to be refinanced at twice the rate today. And roughly $200 billion of these mortgages are in office properties where the underlying value has completely collapsed. Not many are talking about this yet, but the size of the pool of this distressed capital is much larger than the subprime mortgage market at its peak in 2005, which at the time was $625 billion. What are the ramifications of this, and how will the Fed and or the Trump administration respond to this large threat?
Well, I've been talking about commercial real estate for years. I even suggested we should charter the Reconstruction Finance Corp from the 1930s for financing, because that number you just quoted from the Great Crisis, the number is several times bigger now. And the trouble is that not only have we seen a peak in the long-term valuation of commercial real estate going back 50 years, but as you said, it has fallen off rather dramatically. We just saw a peak again in what's called commercial mortgage-backed securities, which is where I would say about a third to 40% of the market gets financed. These are loans of varying sizes that get bundled up into a security and sold to investors, right? Then you have REITs and banks holding the rest of it. Many of the REITs are private, so you don't even see what's going on there unless they publish a notice in the newspaper or you read The Real Deal, by the way, which is a great publication. They're deep in the weeds on this. But we are restructuring large parts of America, particularly urban America. And again, as you mentioned, we're talking about steep discounts to the last appraised value. That means that the equity is going to be wiped out in the stack. The debt holders will become the new owners. Oftentimes, the manager of the property will buy some more equity as they restructure. And then they got to figure out if there's a strong use case for that property. Can we rent it? Can we stabilize it at a new valuation? So in the cities, you see people trying to rehab these things in the residential properties. Tough. But this is going to be with us for the rest of the decade, and the numbers are going to be large.
So, Chris, the Fed drove rates to zero or near zero for more than 10 years. That unleashed the financial mania that we still see today. Are we looking at a situation where when this credit bubble finally blows, all central banks can do is conjure up new fiat, but absent massive financial demand from new market mania, the money can be expected, I'm asking, to flow straight through to basically general prices and real things?
Well, I think what you're going to see is a little different from the way you describe it, which is the main driver for the Fed, I think, is not going to be so much unemployment, but the Treasury. When the Treasury gets to the point where they're being overwhelmed by the growth and the cost of the debt, then the Fed's going to grow their portfolio. When they buy bonds, that makes the deposit base of the banks grow. That makes the reserve base grow. And that's where you get future inflation. So it's kind of an indirect version of what you just presented to us, which is it takes a few years, and we still see it today. We still see the impact of what the Fed did 4 years ago flowing through the economy today. So if they wait until we actually hit the bottom and we get to the point where reserves are inadequate, we start seeing problems in the short-term markets, then you'll see the Fed jump back in and start buying bonds. I don't think they'll buy mortgage paper again. They have been very chastened by that experience. The losses to the Fed are going to be grotesque, and they're not going to stop. I have suggested to them privately that they should CMO all their mortgage debt and sell it, but they don't want to do that because it would be politically very ugly. So that's my expectation. The driver will be Treasury. Now, if you saw a big uptick in unemployment, sure. Would they drop interest rates? But the kind of action I'm worried about is what they do with their balance sheet. It's not the target for Fed funds. It's how much paper are they buying.
So if they don't buy mortgage-backed securities anymore, are you expecting a drop in prices at some point in the residential market?
I always defer to my friend Stan Middleman. I published a biography of him back in September on Forbes books. And Stan, who's been at this for a long time, says misery on the eights. So he's anticipating cutting Fed rates, a little boomlet in the housing market for a couple of years, and then a serious correction, maybe taking us back down to 2020, 21 prices. Now, is that the end of the world? No, not at all.
He's expecting that to occur near the end of the decade?
That's right, 2028.
2028.
Yeah.
Okay.
And, Stan has been through this stuff several times. This is a guy who started life, as a young man broke on food stamps, and he worried about having enough money to go see the baseball game. And now he owns part of the Phillies. Wow. And the way he's done that is by being conservative, reinvesting every penny he makes, and by watching two key variables, unemployment and, the economy. He listened to a guy named Paul Volcker, an old friend of mine, talk years ago about how we do monetary policy. That's it. So if you follow those two benchmarks, you know what's going to happen.
Let me ask you a question about gold. It's only 0.5% of global financial assets currently. Over the last 4 to 5 decades, it has a mean of about 2 to 3%. Do you expect a reversion to the mean in the coming years for gold ownership? And if so, and related assets, and if so, how would you translate that into the price of gold and gold-related equities?
Well, it's funny. I just posited a hypothetical in the blog where the Chinese one day decide to revalue gold in their own terms. In other words, they force a devaluation on the dollar, and they say, well, we'll pay 5,000 an ounce. And they just do it. I've often said, too, and my friend Jim Rickards agrees with me, is that the Treasury ought to be buying gold right now. We ought to undo FDR's horrible betrayal of the American people that I talk about in my upcoming book, and let people use gold as financial assets again. We can already use them in swaps. There's no reason why the Fed shouldn't be holding gold for capital purposes instead of this hedge fund that they've been mismanaging so badly. If they had gold instead of mortgage-backed securities.
Wow. If China did what you just suggested, wouldn't you say that would be cause for war, most likely?
It would be throwing down the gauntlet to the United States and saying, look, we're not going to just accept these pieces of paper you keep printing unless you get your house in order. Now, they have their own problems. The Chinese have deficits and debt that are worse than ours. But all of the industrial countries have this problem. The question is, how are we going to move to the next phase of the global economy where I think countries will have a more balanced relationship, and we may need gold. We may need to have people define values in gold simply because trust in the dollar may not be the same as it's been in the past. See, when you win the war and you have a big army, it's easy to have a hegemony in monetary policy terms. But once that evens out and other nations of the world can start to, stand on their own, you may need to have some other medium to link all these currencies together.
That's a great point. This has been a fantastic conversation, Chris. It really has. Before we wrap up here and I ask you the final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift, it's a must-read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe, and receive the free gift on us. Also, I'm positive that you've enjoyed the conversation with Chris as much as I have. Please let him know. Hit the like and subscribe button and leave a comment below the video. All right, Chris, it's time for a lightning round. I'm going to ask you to rank a few assets as a buy or a sell by giving it a score of 1 to 100, with 100 being extreme buy and 1 being an extreme sell. And then just give a 1 sentence as to why you believe that take, okay, why you're taking that position.
Okay.
All right, you ready? All right, right now on a scale of 1 to 100, is gold a buy or a sell, and why?
I would say it's a 70 and a buy. Because people are worried about paper more than they've been in many, many years. If you look at the Chinese, if you look at some of the other global buyers of gold, they're not stopping. So my hope is that the U.S. is going to figure this out and start adding to our own stocks as well.
That would be fantastic. All right. So right now on a scale of 1 to 100, is silver a buy or a sell, and why?
No, I think we should have silver coins, but they should trade by weight. In other words, whatever the price is that day. And we should do the same with gold, by the way. I would love to see Treasury, when we revise the legal status of gold, start issuing gold coins again. But they should trade on weight, not on the monetary value.
So what number on the scale would you give it?
Oh, a 30.
A 30?
I had silver has been trying to come back since the 1880s, and it hasn't happened. So we have too much of it. That's the problem.
Okay. On a scale 1 to 100, is copper a buy or a sell, and why?
I don't know enough about the ebb and flow. If the global economy is strong, it's generally a buy. I would call it a 50. But, if the economy slows down, copper prices can fall off very dramatically. It's an industrial commodity. And
so we're risking a slowdown right now is what I'm hearing.
Yeah, well, if you are, that's the real way I would put it to you. Copper is used in industry. It's used in many aspects of industry, but that's its primary purpose. With gold and silver, you have other purposes, even, platinum.
So on a scale of 1 to 100, is uranium a buy or a sell, and why?
Oh, I would say uranium is very definitely a buy. I'd put that up around an 80. I think people need to start thinking about how we're going to expand nuclear power globally. Because if you want to reduce fossil, emissions, if you want to get rid of the use of fossil fuels, which I think is obvious, why do you burn hydrocarbons? We need them for other things, right? Makes enormous sense. So I think nuclear is going to have a renaissance.
And it seems like China's off to the races on that, and we may have some catching up to do.
Well, they have a mandate. Listen, mandate-driven economies are extremely inefficient. Look what they've done with EVs. And real estate before that. China is a manic economy. They are guided by politics. So when politicians make decisions, Joe Biden was the same way, right? Bad things happen. Putting money into Intel. I used to cover semiconductor capital equipment as a banker. Intel hasn't been lead edge in 20 years. What are we talking about?
Yeah. Chris, this has been a fantastic conversation. Thanks for coming on to Metals and Miners, for being so generous with your time and your analysis and ideas. Would you please summarize your view that you've covered today and let those know tuning in where that they can learn more about your work and how they can connect with you?
Well, sure. I'm Christopher Whalen. I published The Institutional Risk Analyst. I'm a banker. I provide a lot of advisory services to institutional investors and also financial institutions. And I write a column for National Mortgage News if you're into housing. And I'm on RC Whalen on X, which is always great fun.
Well, I've been following you for a number of years. I will put all this information up on the screen. It'll be click-throughable in the description area. I really appreciate your viewpoint and your sharing, and everybody who is not following you needs to follow you and hear your voice, hear what you have to say. So thanks for coming on, Chris, and I look forward to having you back on sometime soon. And everybody else, thank you for watching.
Thank you, Gary.
It's been a fantastic conversation, Chris. It really has. Before we wrap up here and I ask you the final question, I want to point everyone over to our Substack. Go to metalsandminers.substack.com. We post content on the consumer, economy, markets, artificial intelligence, individual metals and miners, and all the expert interviews that we conduct, just like this one. They're all up there. And when you subscribe, we want to give you a free gift. It's a report that we wrote. It's based on the important Ray Dalio foundational premise. It's titled, If You Don't Own Gold, You Know Neither History Nor Economics. This free gift, it's a must read for everyone on why we all should own gold. So head over to metalsandminers.substack.com, put in your email address to subscribe and receive the free gift on us.